right, so last time we talked about income versus growth. We talked about growth stocks and value stocks, also income versus opportunity. Let's switch the page and talk specifically about income. Not as fun as growth stocks. We talk about Netflix and Google and Apple and all kind of cool stuff because that's fun to talk about. But they can make a home run and make us rich, or they can make us poor. Bonds are a little bit more, well, not a little more, they're quite more stable, they're consistent, and they will give you income. So let's look at what a bond is. Bonds do belong in your portfolio, so you really shouldn't make a portfolio just of stocks. And you certainly should not make a portfolio full of opportunity stocks. That's a good way to lose lots of money and be really upset by doing that. So if I have drilled this in now, a stock is ownership. You own a piece of the company. You literally do. You own the company, a piece of it that it splits itself into. So you will do well with the company if it does well. You will not do well if the company does not do well. So you own that company. When you think of bonds, think of the word loan. Loans are never fun to talk about, but they have a place in a portfolio. So a bond is a loan. A stock is a piece of ownership. So you lend money. You actually do essentially lend money, and you accept a certain yield. A percentage of that money comes back to you for the benefit of the right of that company or the government to take your money. They will pay you these two words are interchangeable, yield and interest. Interest is what you take on something like a bank interest, a CD, a checking account, or that pays a little bit of interest, 1%, 2% per year. You get that. That's interest. Bonds have that. It's called a yield. You get your money back. Whatever you put into the bond, whatever you invest, you will get that back, plus the yield after a certain time, assuming the company or the government doesn't go bankrupt, but normally they don't. So unlike a stock where you may lose everything and not get your money back, bonds, you will get your money back plus a yield. Now, let's talk about a 5-year note or bond, just these different words, at 5% interest per year. So you're going to give $10,000 to a company, and governments like the federal government or local governments, they also issue bonds, but nonetheless, you give $10,000, or to even me or you. It could be anything. A bond is just an agreement to take money and give interest per year. So 5% equals $500 per year. Done. Finished. Every single year, you're going to get $500. So at the end of that term, you will get back $2,500. Depends on how the bond is structured. Some of them don't do that, but nonetheless, 500 times 5, 2,500. So at the end of 5 years, no volatility, you get your money back and $2,500. Not bad. That's income. Boring, not exciting, not like a Google or something, but money nonetheless. So why do bonds exist? Governments, be it the national government, federal government, state of California, state of Texas, whatever, or local, city of Los Angeles, whatever you want to talk about, they issue bonds to operate. They typically operate at a deficit. They raise money through bonds and do their things like building a school, paying whatever the projects they are. So companies also issue bonds for projects and expansions. They can issue more stock, but as they issue and they create more stock, essentially, they dilute the stock price out there. So they don't normally want to do that. They may just go for a fixed term. So 20 years later, we're going to expand this plant, buy this, and we're going to issue $10 million in bonds to the market. That's what this is. So city building a new school, $50 million, issue bonds to pay for it, pay now, or build school now, pay back school later. And then as we go forward, General Electric, same thing, wants to build 5 new plants or buildings, and GE is going to expand. It wants to raise, this project will cost $100 million, and they will borrow the money now, build those plants, and with the profits from the plant, hopefully, pay it back later. They'll give their investors a loan and a yield. You don't own GE. You have nothing to do with GE if you are a bond owner. You're simply getting money. You're giving them money, and you are giving a yield. They're giving a yield back. Not that fun, but it works. So say if you flip the tables around, if you want to buy a house, you don't have the money. Most people don't, at least. Say it's $300,000. Most people don't have that kind of money just lying around. So to get your house, you actually get a mortgage. That's a bond. A mortgage is a bond. Think of it that way. You will pay back to your lender a fixed rate over time, and a bank will issue you the bond. That's what it is. So you are either getting the money, or you are, if you're owning a house or a car loan or a student loan, you're actually participating in the bond market, in a sense. Make the comparison at least. It's just fixed payments over time. So again, federal, state, corporate, and these are the safest. So in terms of risk, going up the risk, I mentioned that you'll get all your money back. Let's hope you get all your money back. Let's hope the government doesn't bankrupt, and the US government, most likely, 99% chance, will not bankrupt. So what's called federal bonds or treasuries, these are the most safe. If you give the government a certain amount of money, you will get that money back plus principal, plus interest, plus yield. State and municipal, sometimes these do go bankrupt. Counties or cities in some states, sometimes, mainly cities and some counties, have actually gone bankrupt and have decided to not pay back their bonds. That can happen. It is extremely rare. But state and municipal bonds, you can also get a tax-free, meaning the interest you get, some of it could be free from taxes. It means you make more money in your pocket. That's really cool. So it's an incentive to go with state and local. Higher risk, a little bit in the federal, but still, you may get some tax-free depending if you live in the city or the state. Corporate, we mentioned McDonald's, GE, other companies can actually, instead of issuing stock, which is splitting themselves out and letting people buy those things, they can go ahead and raise money to build or expand, and they pay for that. A separate class is called junk bonds, which are kind of fun in a sense. The fun part of the bond market is the junk bond market. It gives an extremely high yield relative, but you might lose all your money. So that's the thing about it. You'll find that theme throughout the rest of the, well, throughout everything in investing. The greater the risk, the greater the money you may get, or you may lose. So you'll get a low interest rate here, moderate and higher towards there. So the safer it is, the lower the yield will be. What are the risks? That the company will go bankrupt. GE could, in theory, if you put a 10-year bond with them, they could get sued out of business, or just something really horrible happens and they do go bankrupt. And that, if that happens, you will lose your bond for the most part. They can't pay you back. You don't get your money back at the end of 20 years. That's rare, but it is a risk. So to the extent of what that risk is, the yield will be higher to compensate for that risk. Yields will rise after you purchase your bond. So say you buy $10,000 today in GE, and a couple of months later, at say 5%. But a couple of months later, you find out that that same bond could actually have gotten you 6%. Is that really a risk? Not really, but you left money on the table. So instead of getting 6% per year, had you waited, well, you only get 5%. The opposite is true. If it's at 5 and goes to 4, you feel good about yourself. But the bond yield can change and does change over time. And the bond will be called away. And what that means is, let's say GE puts a 20-year bond out and they build the plant and it's extremely successful. And they say, we don't need to pay 5% per year. That's wasting money. Let's go ahead and knock out our debt, pay off our bondholders, and we'll be set. That actually does happen. It's not fatal. It's not terrible. It just means you have to take your money that you thought you were going to get and reinvest it elsewhere. Kind of a risk, but it's not really that risky. You get your money back, but you don't get to hold it for 20 years. This is what we call this, the bond can be called away. So how do you buy a bond? It's actually more difficult. You can't just click a button for the most part. For the most part, click a button. So you usually have to go through a broker or someone else on your behalf to buy a bond. Not always, but it's easier, it seems like, to do that. There are less bonds than stocks. Makes sense. Less research to do, but less bonds to pick from. And they're usually bought through advisors. We'll talk about that later. Money managers or somebody you can have working on your behalf or a company to buy bonds. You actually can buy them, government or municipal or sometimes even corporate bonds, through the investor relations page on websites. Again, a little bit, you have to call somebody and do money. It's just more complicated. Not that much. That's not prohibitive, but you can't just click a button on your iPhone and your application and get a bond for the most part. It's a little bit more challenging, but it can be done. So on the review, bonds are safe. They're predictable, assuming the company doesn't go bankrupt. And it's just money each year, money each month. You can depend upon that. Usually it's 6 months, whatever. It's money that you're going to get. Buying a bond is like lending someone money. Like a bank lends you money to buy a house, you lend money out to a company or a government to do whatever they want to do with the money. They will pay you a yield for that, and they will give your money back at a certain date. usually 2, 3, whatever the year, the terms, you call these terms, the maturity date. And unless the company goes bankrupt, you get your investment back plus your yield. Your principal and yield come back together. And bonds are less risky than stocks, but as you might suspect, they return less.